Hello and welcome to the Weekend Investing Daily Bite of January the 13th. 13 number is a bit of an unlucky number, they say, and it proved to be so for the markets today. The markets got rogered uh, left, right, and center. And this is one day which uh, I guess once in a while you will have to bear, in the sense that this isn't the part of market investing. uh, you'll go three steps forward, one step back, and today definitely was that one step back. So a lot of damage in the markets. Chart patterns have been damaged very badly. But then, as they say, neither the markets can rise to the skies, neither can it fall to the ground zero. So you'll find balance and equilibrium come in, hopefully sometime soon. Stock markets have been painted in red. Are these signs of extreme stress? Let's discuss that in the second half of the video. Please do read the disclaimer and do subscribe to the channel if you haven't so far. The market's continuous fall. We had a gap down today, and ever since we've moved below this 23,300 in the morning, there was a feeling that we are finally leaving this support. The market did come back to retest this level, but could not sustain it. So 1.5% down on Nifty. We've gone almost 1,200 points down in the last 7 sessions. Markets are definitely oversold. A dead cat bounce at least can happen anytime. Uh, we may open gap down tomorrow and do a bounce from there, or we may just go up in a bounce from here. But a dead cat bounce is very much on the cards now. That does not say that markets has bottomed here or the markets will take a U-turn and go up. Nothing of that kind is being inferenced here. The big damage happened in Nifty Junior, 4.32% down. Nifty Junior peaked near 78,000 and we are already nearing 61,000. So almost, why almost 20% plus is gone now on Nifty Junior, and this has been one of the worst hit indices. Possibly because a lot of funds were moving into Nifty Junior ETFs, etc. Maybe it is the quantum of funds that really went there, could have been the reason. Mid caps also not spared at all, minus 3.92% on mid caps. We've gone from 21,500 to 19,500. So 10% cut in last 6-7 sessions. Very, very deep cut has happened since the start of this year. Small caps also not spared, minus 4% down. Here also we've gone from 18,000 to 16,000. Notice that every time in the past we've gone, 10% in such a quick time, there will be relief rallies, there will be dead cat bounces, although there may not be a U-turn of sorts, perhaps. If that happens, nothing like it. Nifty Bank also down. It tried to do a gap fill from where it dropped. It's now at 48,000. We have been dropping since 54,000. So good 12% kind of a down move has happened here as well from the recent tops. Momentum trends, only 481 declines out of 500 and 18 advances. So there was nothing advancing today. The 18 stocks that were advancing should be listed and seen why they were advancing today. There may have been some special reasons or mild advances like TCS here or Axis Bank here. So you can see a host of it's a red sea situation. HDFC Bank continuously down each day, 1.5%. And these are heavyweights of the kind, 11%, 12% weightage. So if HDFC Bank goes down, Nifty goes down, Bank Nifty goes down. State Bank of India 1.8%, ICICI Bank 1.6%, Wipro down, uh, Mahindra down, Tata Motors down. Then you had NTPC, Power Grid, Trent, BEL. Anything that you talked about was down. Reliance for I would say, good measure was flat. Hindustan Levers was flat. TCS was slightly positive. Infosys was flat. I think so this is the saving grace for the day. Otherwise, Nifty also would be 2 or 3% down. Nifty next 50, sharp, deep reds everywhere. You had DLF give up 5.5%, Adani Power 6.7%, Siemens, ABB nearly 5% each, DMart 5%, HAL 5%, IOC 6%, Zomato 6.5%. I think anybody and everybody who had to sell something they were selling. And this is a process of shafting out of not just weak hands, but people who are trying to time the market also. So everybody who's selling today is wishing that the market falls further and I'll be able to get back in. That can happen or may not happen. You never know. So uh, very experienced hands are able to do that, and they would have gotten out much earlier perhaps. But it does seem like we are sensing some sort of capitulation. Capitulation is that phase of the market where, at least for the short term, some interim bottoms get made, and that may be a situation we are near. I'm guessing here. Lodha down 9.2%, Geofinance 5%, because when you have a complete wash of the markets, it usually is near those points. Sectoral trends all red, no points for guessing that, but real estate hammered like anything, 6.5% down on this one sector. Public sector enterprise down 4%, metals nearly 4%, energy also 3.3%, commodities 3%. The only places where you had some lesser fall was private banks, FMCG, IT. These three sectors were the places where you did not really fall too much. For the week gone by, real estate is down 11%, and PSU banks at 7.2%, and public sector enterprise at 7%. These are the deepest cuts. So I think market has zero expectations from the budget. It is having zero expectations from the results from here till the budget. So the expectations have really suddenly tipped quite dramatically, and that's being reflected in the markets. Real estate broke down from a important support today, down 6.5%. You can see the damage. Phoenix Mills, Brigade, Macro, Soba, Godrej, all losing ground. Nothing much has changed in reality on ground for real estate, but the stock prices will do their thing. So one should always dissociate what is happening on ground and what is happening in the markets. There can be a huge lag between the two. Maybe this will come down, rebuild and go up, while the physical homes never have a correction for now, and maybe they will have a correction at some point where it may not reflect in the market. So this need not be all the time correlated in sync. So stock markets painted in red. Let's see what is the chart say. So we have been along a certain trajectory that seems to be a bit shaken up now. We are now in that range where the June 4th this candle was formed. This was our base case that we'll stop here at the top of it. We haven't. So now we've opened up this range. So the base case, the worst case for now has moved to the bottom of this range for me. So we may play around in this range. That's where we are on the Nifty. S&P 500 also incidentally is not doing well. It is also looking like a distribution sort of a chart. So the US markets may now start to fall, and that again may not help the Indian markets maybe. Sea of headwinds have struck the market. So headwind number one is dollar index. This has been continuously rising from September mid and is up to nearly 110. When dollar index rises this much, uh, all other emerging markets, currencies, etc., they take a backseat, like we are seeing on the US dollar INR, and all flows start to go towards US dollars and US dollar assets. And that's exactly what FIs have been doing. Rupee, which was somewhat stable in 82, 83, 84 rupees. Maybe the previous governor didn't was having a policy of spending dollars to keep rupee stable. That has been let go. So, the rupee has been left to find its own path. We are now at 86.40 at the time of shooting this. There's a lot of talk about 90, 95. I don't know if that comes or not, but um, whenever you will have that kind of a talk in the market, nobody who's actually wanting to bring in money right now will bring in. All NRIs will stop their repatriation. Sorry, the incoming money. All FIs who are wanting to bring in new money are going to now wait, and anybody who wants to take out their money out of India will now hurry up in taking that money out, because that 90 thing has become a narrative, and everybody is expecting that. Hopefully, whenever we have a narrative which is sort of prevalent, it never happens, but let's see where this goes. So headwind number two, rupee at all-time lows. FI outflows are increasing. the demand for dollars and putting pressure on the rupee. Weakening rupee is also a currency risk for FIIs, so further outflows. So it's a self-fulfilling cycle, self-feeding cycle. Rupee weakens, FIIs think, why should we stay in the rupee? Let's get out. We can come back in later. When they get out, it puts more pressure on the rupee. It falls further. More FIIs go, and it feeds itself from that point of view. Headwind number three is US dollar 10-year yield. This has been rising like crazy. We are at 4.7% already. We were near 0.5% just a couple of years back. This is causing all kinds of money to go towards US treasuries, towards US yields, because now if Indian paper is yielding you 6.5%, 7%, and US paper is yielding you 4.7%, and there's a depreciation of 3 to 4% every year, who is going to put their money in Indian paper? And similar is the situation with a lot of other uh, uh, treasuries available worldwide. So all that is also causing a huge problem. The expectation was that Fed would cut the rates in January, but Fed has held the rates, and it's boosting the dollar and yield even further, because their jobs market is very strong, and you know there is no reason. In fact, it is too strong from even from their expectation, and they may have to raise the rates. I mean, nobody is able to bell the cat of interest rates right now, and the interest rates continue to rise. FII selling, of course, is the fourth headwind for Indian market. Continuous selling, 5,000 crores, 4,000 crores on a daily basis. DIIs so far have been matching the outflows. I'm not sure how long they can do that, but for now, that is fine. And the FIIs selling is causing a sentimental problem for Indian investors more than anything else. As you can see, 57,000 crores have come in by DIIs this last 1 month, and 47,000 crores have left. So net institutional money is still positive, but the market has taken a beating. Crude oil is the sort of dark horse in this entire thing, where crude oil is looking to flare up. It has already flared up from $70 to $81. This is Brent oil. And India, as you all know, two situations really hurt India: high crude prices and low rupee conversion, and both have hit at the same time, along with other headwinds that we are having. So it's a culmination of a lot of things which is causing a fulfilling, self-fulfilling of this selling process. So and of course, there was talk of the slowing down of GDP and so on and so forth in the last few weeks, and that is also building in the minds of people that slowdown is happening. Let's get out of the market. So all this is happening, and this is causing this delusional impact to many investors that we should step aside and let it all burn down to the ground, and then we will come and buy it. It never happens like that. Only once in a lucky break you will be able to do that, especially if you have significant portfolios. If you are just playing around with stock markets with some 2, 5, 10% of your money, then it's more of just a trade coming in, going out. But if you are well established investor in the market, you should not be playing those games. This is a serious market, long term, with long term prospects, and that's what you are playing for in terms of where you want to be. So all this noise, everything is in the short term. You have to disassociate yourself from this noise. You have to keep your long term goals intact. What is my goal from the market? How am I going to execute in the market? Does today's fall impact that rule that I have? If it does, take action. If it does not, do not get swayed by the sentiment. That is the key to staying in your long game. Long term, you can see we will continuously get periods where we will not do well. There have been so many. I mean, COVID looks like a small fall now in the entire thing now, right? So this may end here, or this may come down to maybe 20,000, 21,000, perhaps, or maybe some really disaster happens, we may come down to 18,000. But the trajectory remains up, and you need to see that while the trajectory remains up, these hiccups will be there. You have to absorb them. You have to persevere through them, because you know that the pot at the end of the rainbow is full of gold. That confidence you must have in the market. So our objective is not to get into these reasons of ups and downs. I've listed them because that's what the everybody is looking for. But in terms of really the matter is whether money is coming into the market or not. That's the only matter actually. Whether liquidity is coming in or liquidity is going out, how much of it is coming in, how much of it is going out, that exactly is the matter. If there's enough confidence and demand at any certain level, market will hold that level. If there isn't, if the sellers want to get out at this level, then market will continue to go down. So it is all a demand supply situation at the end of the day, that the market has to find an equilibrium where buyers can satisfy the demands of the sellers and sellers can satisfy the demands of the buyers. That is how the situation will go. Market has had fantastic 9 years consecutive. Even if we have a year like this or like this, I see no reason to panic. This is a amazing 34-year chart in front of you. I mean, if this is not proof enough that the market is a robust market to go forward, nothing is. So anyhow, so basically rule-based systems, we can help you navigate this better. See, what happens is that this is a behavioral game. Why are we even at this stage of the market? Because some people's behavior has changed. Earlier, it may have been into greed and lusting for more profit. Now it is fear and wanting to play a smart one by setting aside from the market and then coming in later, something like that. So this behavior of investors is causing these changes, even up on the upside as well as on the downside. So you have to step aside from the behavior, that let people misbehave in the market if they have to. I will follow my rules. I know my rules will keep me invested in the market, keep me with the winners of the market, even if they also may be going up and down. You may have all the stocks in the markets which are losing, but there are still relative winners there. So the fact is that your approach to the market, your behavior to the market, your psychology should not deviate even in such times. You have to remain calm. You have to disassociate basically. I I I don't know how to convince you on this, but I'm not worried today, for instance. I mean, yes, it is painful to watch your investments go down, but the larger picture is that you are playing your games by the rule book that you have made, and that ensures that over a period of time you make money. That confidence has to be there in your mind when you do especially rule-based investing. So two types of investors are there: one who will panic, who will stop their sips, remove the money from the market, maybe even go short, or do all kinds of jugglery with their stocks, or do concentrated betting, or try to recover one loss from buying another one, and leveraging on it, doubling down on that, averaging out, things of that kind. And then others are there who are on the long haul. They are continuing whatever they were doing, and they're patient during correction. In fact, in deep corrections, more invest more or lumpy payments can be brought in. The market's not going anywhere. Yes, market's adjusting to a new equilibrium at different points. It may not happen that today maybe the lowest point. We may go even lower. But then when it starts to rise, whenever it does, there will be no alerts, there will be no signals that market is rising. You will one fine day you will find that the rates have gone up and now you're not able to buy anymore. That's the kind of market move that always happens. You can go back in history, and that's always the case. So it depends upon what kind of investor you are. Do mention in the comments how you are treating the markets, with what kind of lens going forward. Thank you so much for watching, and do like and share this video. Do subscribe to the channel. Do not worry about the markets. Thanks. Bye.